All right. Hi, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We've got the crew from BI, Fernando Valle, joining from New York, Will Hares and Patricio Alvarez here in London, and we're thrilled to welcome a special guest this week. We've got Kevin Pollard from Pickering Energy Partners, where he's a managing director of research. He brings a wealth of knowledge and experience to today's conversation. And we're going to get started with the big picture. In a speech yesterday, Saudi Aramco CEO Amin Nasser raised the alarm bell about new oil and gas supplies. Industry-wide investment has fallen from something in the neighborhood of 700 billion US dollars a year in 2014 to roughly 300 billion last year. And so, Kevin, I want to gauge you on this topic. Do you share this concern about potential underinvestment in new supplies, and how do you read the overall market landscape right now?
Okay, thanks, Rob. Appreciate you guys having me today. Yeah, we do share that concern, and yeah, frankly, I think we would be in a much tighter spot were it not for some of the economic slowdown that we're seeing around the world already. I think these things would be coming home, and we'd be facing much higher commodity prices, not just in Europe but globally. Um, it's absolutely kind of a central issue that we're going to have to deal with in the coming years. You look at OPEC spare capacity; it's very low. You look production growth has been coming in, even in the U.S., where people seem to think we can just flip a switch and produce as much as we want and fill any holes is underwhelming, and we continue to think it comes in lower than consensus forecasts. Even in Europe, despite the energy crisis that they're dealing with, there doesn't seem to be, this renewed appetite to invest in fossil fuels. I mean, we see things, the responses seem to be things, like, well, we've got the, Repower EU and things like that, as opposed to, how can we, develop a more reliable, traditional energy supply chain. So
When you think about the run-up in European gas prices, how do you read the tea leaves? What's the right mix between focus on demand, new alternatives, LNG, other resources that could come into the region? What would you advise is the right course of action? We're all looking at relatively high energy costs as we head into winter over here.
Well, yeah, I think diversity of supply. Well, first of all, I think you're just acknowledging that fossil fuels are going to be a much bigger part of the mix over the next 5 to 10 years than the EU perhaps was thinking a year ago. And just you've got economic and political realities that you're going to have to rely more on fossil fuels, and mostly, I think this is going to be in the form of natural gas. Um, Obviously, diversity of supply is going to be important. The record LNG imports are helping refill storage to a large degree, but it's a tougher solution, though, right, than when you had historically relied on Russian gas, because the pipeline infrastructure isn't as flexible in terms of getting the LNG where it needs to be necessarily. And then, I think there's still this resistance. It seems to me that, particularly in the EU, that natural gas needs to be part of the long-term solution. I mean, you look at, some of the mandates on, in the Repower EU, for example, they talk about, well, if we build import terminals, they need to be, designed so that we can switch them to hydrogen and ammonia in 10 years. At our conference here in Texas last week in Austin, we had one of the sponsor of the Lake Charles LNG, and the question came up why they've sold half of the capacity of that plant so far, and with the exception of a Shell BG contract that was announced recently, all the offtake has been Asia. and the question came up, why not? Why is Europe not participating more? And they highlighted two things. One is there's a creditworthiness issue these days. And you've seen some of that with the gas marketing companies and utilities in Europe. But the other is just an unwillingness to sign the 15 to 20-year contracts that they want to underwrite this project. And I think that kind of gets back to this perception in Europe that we need some gas, but we only need it for like 5 years and then we're good. And I just don't think that that's the reality.
It really does flip the gas as a bridge fuel demand narrative kind of on its head. Do you think that gas will be seen in other markets as this transition fuel? Because I really don't see it being seen that way over here, and I think that gets to your reticence. But how do you sort of see gas in the overall energy mix over the medium term?
Yeah, absolutely. I think it's a transition fuel. I think you can think of it as two ways. A transition fuel in many markets from coal to something cleaner, or I think we tend to think of it as a in many cases as a bridge fuel, but really I think it's a base fuel. For much of the world, and I think ultimately Europe is going to have to come to a similar conclusion. It may take a little bit more pain and evidence of some dysfunctional policy making to sort of make that a reality.
Yeah, Kevin, and to add to your point, I attended the Pickering conference last week as well. It was a great event, and one of the interesting things that came out of that was on the CCS front. Putting CCS on gas plants is one of the easiest ways of capturing carbon in any process. So I think that's one of the big differences of opinions, and Will can comment on this too, between BP, Shell, Total, and Exxon and Chevron, is that Exxon and Chevron believe we're going to continue producing energy near the current mix. Obviously, renewables will take some market share, but as opposed to the view in Europe that it's a 5-10 year horizon in natural gas, they think we'll probably be doing it for most of this century, if not all of it. And the best way to control the emissions is to capture that carbon, to cap your methane emissions, and to utilize existing infrastructure, but in a cleaner, more environmentally friendly way. And again, I think another point from the CCS panel at the conference was the new 45Q, that's $85 a ton for CCS, really enables a lot more projects on the high saturation carbon projects. Not yet on the lower emissions, but the high emitters, your gas processing plants, your power plants, some refineries, some petrochemicals, those are enabled. It's just there's still a bit more to flesh out, especially on the regulatory front, but it's a start.
Will, you've got a note out just the other day on 5 challenges for Shell's incoming CEO. How do you think about the question of CCS? Is it something that's on Shell's mind or any of the other European majors?
Yeah, thanks, Rob. So certainly CCS is on the mind of all the integrated oil majors, just to a different scale. As Fernando was alluding to, the Americans are hinging their energy transition strategies much more on CCS options than the Europeans are. This is contributing to a very distinct energy transition pathways between the Americans and the European integrateds. We're seeing the Europeans lean much more heavily into renewable power generation, as integrating down the power chain, buying up utilities, developing EV charging networks, a couple of them getting into batteries as well. Meanwhile, the Americans have a much more business as usual approach as it comes to the upstream part of their portfolios, whereas the Europeans are obviously looking to reduce their portfolio emissions intensity via evolution of their product mix. And we're seeing that happen relatively quickly particularly with say BP, who is looking to reduce their upstream volumes by nearly 40% this decade. So we're seeing very, very different, pathways and takes on how the energy transition is going to evolve. And I think to date, we have to acknowledge the Americans, Exxon and Chevron, are very clearly benefiting from a pretty significant valuation premium as compared to the Europeans.
Kevin, I want to circle back around on the idea that Fernando was just talking about with CCS. What do you make of the technology? Do you see a renaissance for carbon capture and storage? And does the Inflation Reduction Act or any of the other recent policy discussion help push it along?
Yes and yes. So I think I would agree with Will's characterization for sure on the way U.S. majors are approaching the transition. I think all of them have viewed it, moves into solar and wind and things as just a radically different return profile than what they're used to, and perhaps outside of their core competencies, and just really chosen not to go down that route. At the same time, they're very acutely aware of the pressure, and the disruptive potential of the energy transition. And so I think their strategies have centered around, what can we do to make our product more palatable to the widest, group of consumers, and in that, I think a lot of investment in methane reduction and certainly carbon capture will fall into that bucket as well. There's the IRA is going to be very helpful for this on a lot of fronts. The production tax credits, will certainly improve the economics considerably, particularly in the early days when it's expensive. But it's not just the tax credits; it's some of the financing vehicles as well. If you think about the tax equity, which has been a very common mechanism for wind and solar in the U.S. It was difficult to get financing, tax equity financing for CCS, because these are sort of serial number one projects in a lot of cases, and the banks that provide tax equity funding in the U.S. are looking at a 7 to 10 year sort of partnership before it flips out and ends, and they just didn't want to participate in something that new. With this, you get kind of a 5 years of direct pay, which sort of alleviates the need for some of those partnerships, and that'll give you time to build a track record of these things. Then you can go back to bringing in traditional renewable energy tax equity partners down the road. And there's also the ability to sell the credits directly, monetize them. So you have more pathways to finance these things. So it's not just the tax credits. Don't get me wrong; those are hugely important. But also, the IRA is going to provide a lot more flexibility in how these are project financed.
It's been about 10 years, but I remember speaking at a conference and having folks in the back of the room stand up and start protesting because I had mentioned the idea of CCS. But when you think about these net zero goals, it really is hard to envision how you get there without some kind of technology like that. And so I want to come over to you, Patricio. You've looked a lot at REPower EU. You're very up to speed on what's happening with the gas crisis in Europe. What do you make of the solutions at hand? Is CCS one of these things we're going to see much of here? My general sense is much more about hydrogen, but give us your thoughts.
Sure, Rob. Thanks. I think I would concur mostly with Will on this front. Really, I cover power generators in Europe, and none of them have exposure to CCS or have plans to go into that sort of space. I think it's mostly European majors that go in that space, and it's always sort of a repurposing of their existing infrastructure to sort of try and extend the life of their assets as well. But we don't see that too much on the midstream and on the utility sides in Europe. In terms of the measures that we're seeing the European Commission sort of push forward to try and temper prices, we don't see really something of of a major pivot, like Kevin mentioned in the beginning. It's still a full, almost blindsiding push for renewables to accelerate wind and solar developments as fast as possible, and also sort of including natural gas within the EU green taxonomy has still up for debate, given that as it's been mentioned before, it's really hard to incentivize long-term investments when you place this constraint in terms of the length or the tenure of the contracts, and also these are supposed to be built for purpose. So these are plants that need to be built to be hydrogen ready from the onset, and that just places this level of uncertainty, I think, for developers as well, given that regulation on hydrogen is still very much incipient, even though Europe is one of the most ambitious green hydrogen, I'd say, geographies. It's still fairly nascent and uncertain into how that will fit in. Because again, I think that the crux of averting or prolongation of this crisis is both diversifying supply, but also trying to sort of reshuffle the heating mix in Europe. Europe is very much reliant on gas for household heating and industry, and hydrogen still, I think, a very far away solution to decarbonize or to degasify demand in Europe. And sorry, go ahead.
Well, Fernando, I was going to come back to you because one of the things we've talked about in the past is the idea of diesel and other liquid fuels coming into Europe to help us out this winter. Do you still see some of that occurring? And what role do you think the U.S. oil industry is going to play in helping Europe get over the hump that we're facing over the next year or two?
Yeah, I think it really depends on the intensity of the winter at the end of the day. Germany in particular, but a lot of Europe has done a good job of refilling their gas inventories, natural gas, I should say. And they're in a place where they're not necessarily going to be swimming in natural gas at the end of winter in any case, but if there is a cold winter, there's still exposure where they could look for fuel oil or diesel as a way to shore up the demands and make sure that you can continue to provide these heating and power to your citizens. The industrial side also, you talked a little bit about demand being curtailed. That's another portion, that you can flex a little bit more, obviously with dire consequences for your economy. But I think the portion that's most interesting is we've talked a lot about Europe, but we haven't talked enough about New England because they're basically on the same boat. We can't get new pipelines through New York. Most of the heating is diesel. I mean, it's heating oil, but it's really diesel after 2018. And Boston imports LNG sort of from Russia and diesel. I mean, usually it goes through different routes and winds up in Boston. And that pathway is clearly closed. And it's hard in the U.S. to move any products from the Gulf Coast to the East Coast because of the Jones Act. So if there's an issue, and remember earlier this year we released the heating oil reserve in order to lower diesel prices, and New England could be in a really rough spot. And their grid was already in bad shape last year. This year I should say. In January, renewables are contributing less than 7% of the power, and a lot of that was biomass, i.e. wood burning, which is not exactly the most carbon efficient way of doing it. So I think at the end of the day, we expect a bifurcation still. It's already there, but an even wider bifurcation of diesel and gasoline margins. You're seeing the pressure on gasoline margins erupting in Asia, where the crack spread is negative for Singapore, and we think that's coming west. And as we go towards winter, the $30 spread today may even blow up to a wider range, which is crazy to think about.
Kevin, I want to bring you back on here. I think one of the ideas you and I were talking about the other day was there's companion legislation to the Inflation Reduction Act that focuses on pipeline infrastructure, permitting, that Senator Joe Manchin has been advocating. Do you think that this permitting infrastructure type bill has much chance? And if if it doesn't happen, what do you make of some of the differentials that Fernando was just mentioning?
Rob, our timing is good on this because there's actually been a couple of developments on this front since we spoke earlier in the week. In fact, today, I hadn't seen it as of a few minutes before our call, but sometime today, Joe Manchin has announced he's going to actually release the bill so that people can get a look at what's specifically in it. Because there was a framework agreed to, and that included, things on expediting permitting reform and sort of limiting legal challenges, things that create these never-ending delays. But there was no actual specifics. So we should get, this today. And the part of the reason there's an urgency to it now is the plan, the Democratic plan is to attach it to a continuing, basically the budget extension bill. The U.S. government, budget runs through September 30 every year. And so we're coming up on the continuing resolution time where they can kind of kick that deadline down a little bit. And the plan is to attach it to that and hope that, enough people don't want to shut the government down that they'll vote for it. There seems to be a fair amount of opposition, though. And so, things can change. Even within, so unlike the IRA where you could do it via budget reconciliation where you just had to have, all 50 Democrats plus the vice president, this is a traditional piece of legislation. It will require kind of a 60-vote majority in the Senate, which means they need to get at least 10 Republicans on board. But they actually probably need more than that because you've had a number of the more progressive side of the Democratic Party come out in opposition to it. I mean, Manchin himself, estimated he might need 20 Republican senators, and that feels like a difficult ask, given I think the Republican Party feels like, somewhat betrayed, I guess, and he pulled an end run around him with the IRA, which is all true. He did. They literally announced it hours after the chip semiconductor bipartisan bill went through, and that was a bill that, Republicans had said, well, we won't play ball on that if you're going to do this budget reconciliation. And I think they thought they were clear and then found out that behind the scenes there was a lot of maneuvering going on. So, there's a lot of sort of acrimony is probably the right word. and then even then you had, fairly, powerful Democratic senators like Bernie Sanders said they won't vote for, the continuing resolution if it's got this pipeline bill attached to it. And so, and that's just the Senate. Then the House, you've had, 70 Democrats, sign a letter, opposing, packaging it with the continuing resolution. So, there's kind of a game of chicken going on right here. I think, first of all, and then we haven't even touched on the last wrinkle in this is that Manchin's fellow Republican senator in West Virginia announced her competing legislation that basically skips a lot. It proposes actually eliminating a lot of the environmental review as opposed to just putting a time frame on it. As you probably aren't surprised, that has gone over well with her Republican peers. And so there's a lot of moving parts. I think we'll know a lot more over the balance of this week and next. But so we should get the language that Manchin's actually proposing today. And this is going to be kind of I think this is going to come right down to the end. Ultimately, I think they will probably not include it in the continuing resolution if they don't think they have the votes. And the reason is because if you put it in there and draw that line in the sand, then people are faced with the decision of, do we shut down the government a month before the midterms? Even if it's just briefly, that doesn't play well. So, I think if it makes it in there, that means they think they have the votes in the Senate. And if they get it through the Senate, then the House is going to be under tremendous amount of pressure. Again, do you want to be the guy who shuts down the government right before the midterms? And so people who may oppose it in principle may actually go along with it. So the good news is if we could get this done, it would be hugely positive on multiple fronts. Obviously addressing some of the things that Fernando was just bringing up, with the pipeline constraints, and Joe Manchin's indicated, that he's specifically setting it up to get the MVP pipeline that's been stalled for years, through. But there's a lot of, clean energy and transmission related stuff that gets held up in the permitting process as well. Everybody thinks clean energy is a great idea until you want to build a transmission line near their house. So we'll see. I think we're going to know a lot more how this plays out over the next 7 days or so.
Sounds like some strange bedfellows a little bit to get the oil pipeline crowd and the energy electric transmission crowd that supports wind and solar on the same page. Let's see how it goes. Patricio?
But I don't think they're as far apart, on the permitting reform as you might think. I mean, that's a pretty popular topic in Republican circles. I think it's the real complicating wrinkle is the acrimony that exists on the Republican side of the party because of the IRA and the way that they kind of did an end run around them in that process.
I was going to say that we have some very similar sets of constraints over here in Europe. And so, Patricio, I wanted to gauge you a little bit. I know that REPowerEU has a lot of discussion around the idea of permitting reform as well. Do you see faster transmission and other development timelines as a result of REPowerEU and really getting the needle moving more quickly on some of this big infrastructure spending?
So I think that the short answer is nothing very clear, at least not in the current form of the legislation. It's more of recommendations and how to speed up supply chain bottlenecks and permitting delays. But these are pretty much at the discretion of individual EU members. So this is still a massive hurdle. I think one empirical example is Poland, where more than 20 gigawatts of new wind and solar are still pending connection, and that's mainly due to permission. And another way or an interesting fact is that you look at the compounded annual growth rate of renewables. If you take the REPowerEU's 2030 target as the target, let's say in the future, it's about 15 to 16% growth per annum. And that compares to regulated asset-based growth, which is sort of the proxy for transmission and distribution power lines. It's between 4 and 5%. So you see the lag. I know that those are not perfect numbers and perfectly correlated, but that just shows you the level of spend that is going into building the infrastructure needed to connect this new renewable capacity.
We always push the limit here on timing, so we'll probably run a few minutes over time here. Will, I want to come back around to you. So Kevin mentioned the idea of returns on clean energy, and I know that given many of the oil majors or energy majors, as they want to be called now here in Europe, have solar and wind portfolios under development. How do you think about the returns for those type of investments, and how do they compare with traditional upstream types of projects that those companies could have allocated capital toward?
Yeah, I think there's no real way around it. It's a historically lower margin business, and in some areas significantly lower than conventional oil and gas. Most of the European oil majors are approving oil and gas projects at 15 to 20% IRR. They're looking for their newest generation offshore wind projects at 8 to 10%, so it's significantly lower. And I think this ties in well with the topic we touched on earlier. This valuation discount that the Europeans have versus the Americans, and very, very different pathways that they see for the energy transition. This is an unfortunate reality for the European majors, which are moving heavily into renewable power. This ship has left port. It is not slowing down or turning around. These companies are moving hard and fast despite these lower returns, and I think that is what we're starting to see play out in their valuation. And I think, as you brought up, Shell's incoming CEO at the end of this year, Shell's returns have been a recurrent issue that investors have been clamoring about. Their returns have underperformed their peers. Their share performance has been average at best versus peers. Their total returns has been average to lower than peers. Their dividend has had a sluggish recovery on top of the largest cut that we saw of any oil major in response to the COVID-19. And I think finally here is that Shell was kind of caught on the fence a little bit, and this was one of the major criticisms of the outgoing CEO, Ben van Beurden, was that Shell was trying to play both sides in that for some investors, it didn't focus enough on fossil fuels, and for others, it focused too much. It was trying to play the ESG pressure largely from the European investor base, and also trying to appease maybe some of their more conventional shareholders. And I think as a result, he never ended up pleasing either of them, and I think that is at least partly contributing to where the company's performance is at, and I think will encapsulate the main challenge that the incoming CEO, Wael Sawan, will have to contend with.
Fernando, do you agree? Is the valuation discount that we're seeing over here primarily a function of the increased capital allocation to renewables and other things, or are there other factors at play?
I think there is an inherent issue that leads to that, which is there is social, legal, and governmental pressure from the stakeholders at BP, Shell, Equinor, Total, that underpin those investments, right? They're not making them in a vacuum. Shell, notably lost a legal case about global warming and emissions in Holland. So I agree. Ultimately, that's reflected in lower returns and that push towards lower return investments. But there's also all the worries about the legal and governmental ramifications. We saw the UK putting a withholding tax on oil companies, now a solidarity tax for European companies. So I think that all plays into it. And then lastly, and this is the third derivative of it, but I think because of those lower returns and the uncertainty about it, because again, BP was kind of laughed out of one of their wind projects because they bid, twice as much as the next closest bidder. But so there's uncertainty on their ability to deliver on it as well. But it's ultimately reflected on their dividends, right? And that's why they've moved into a variable dividend system, while Exxon and Chevron, I think this is a big part of why they haven't continue to grow their dividend, and they're very adamant about defending that.
So Kevin, we're going to come back to you.
I was just going to say there's probably an element. I would agree with everything Fernando just highlighted, and I do think the return differences are probably a lot of it. But there's also, I think you can't discount entirely the ESG pressure on the investor base in Europe, and the divest all things fossil fuel there's some of that in the United States, but it's much greater in Europe than it is in the United States. And so, I think of what a lot of these European, energy majors, as we're calling them now, deal with is, even though they're spending all their growth capex on renewable, they still get treated as a fossil fuel company in when the big pension funds and stuff are looking at, okay, we don't want to own this, and so I think that you end up with probably a smaller investor base to deal with, or potential investor base, and that has cost of capital implications as well. That I think the Exxon and Chevrons of the world in the U.S., while they deal with those things to some degree, it's certainly not as the pressure is not near what it is in Europe, and especially with oil having recovered nicely and the dividends flowing strongly.
So Kevin, given we're bumping up on the end of our time here, I kind of want to ask you a philosophical question, I suppose. You've painted a pretty sort of all of the above picture as I think of it, and I think when you think about the U.S. energy landscape over the next kind of 5 to 10 years, you've got the Inflation Reduction Act, maybe you get this new infrastructure bill. Where's the focus going to be? Is there still going to be a healthy emphasis on upstream and growing output, or is the U.S. just sort of a laggard and sort of follows the way of Europe, where everything seems to be about solar, wind, hydrogen, and these other newer technologies? How do you see, the sort of medium-term landscape unfolding?
Well, I think it's going to be a lot similar to what it has been, in the sense that the traditional oil and gas producers are going to stay in their lane, so to speak, and not branch into the wind and solar. I think there'll be plenty of that, but it won't be done by the oil and gas companies as it is often in Europe. I do think this new business model or evolved business model to sort of refocus on returns, relatively limited, high profitable growth, and allocating a large portion of the cash flow to returning it to shareholders. That model is not going away, I don't think. If we get an economic recovery in Europe and China, and all our longer term, intermediate term views on crude, the underinvestment impacts that we talked about at the outset of this call come to bear, they'll probably ramp up their growth. They'll have to, but they'll do it in a much higher commodity price environment, so I don't think their investors will care. But I think this notion that just every time anything gets tight, these guys will just grow, is misplaced, because I think the discipline's going to stay for a while, and so I think you have to keep that in mind as you think about what's the U.S. Oil and gas industry going to do. They're going to follow that playbook. It's working well for them. Their share prices are up. Dividends are up. Everything you want is going the right direction. Having said that, I think we're going to see a tremendous, ramp up in both wind and solar, particularly solar, in the U.S. And the IRA will do a lot for that. I mean, just the certainty of the 30% investment tax credit for 10 years is huge. And then some of the flexibility around ability to monetize those tax credits is a big deal. The thing I think we have to keep in mind, though, is most of the benefits on the IRA, are probably, a couple of years out, just because, the IRA is not going to change the supply chain issues, right? We're still holding Chinese modules in customs as we, audit the Uyghur forced labor, issues, and you still have a looming, anti-dumping, countervailing duties case that's not fully resolved. So these things, we have, big delays in interconnection, that aren't going to go away because of this. And so I think it's the 10-year outlook for wind and solar is dramatically improved by the IRA. I don't think that things change a lot in the next 12 to 24 months from where they were.
Makes a lot of sense from our perspective. So I think that's where we're going to have to leave it, because we've already run over just a little bit. Kevin, thank you so much for joining us. For anyone who's listening, if you want to reach out, Kevin is on terminal. He's a green dot right now, so you can shoot him an IB and ask him any follow-up questions you might have. And so thanks so much for joining us, and we'd love to have you on again sometime soon. And Fernando, Will, Patricio, thanks as well. We're all on terminal, so if you have questions, follow up, you want to learn more about the research or anything we've discussed, we're happy to chat further. I hope everyone has a great remainder of their week.
Thanks, Rob. Appreciate you having me.